So the question of what separates Bitcoin from other cryptocurrencies, because when I initially covered cryptocurrencies years ago, my biggest issue was, okay, so Bitcoin's neat, it's got a hard cap of supply, but anyone can fork the protocol and make their own version. Someone can come along and copy it and change the rules a little bit, make their own version. And so my concern was that if Bitcoin or another big cryptocurrency doesn't capture most of the market share, then any capital that goes into space could become very diluted among multiple projects. We tend to see that happen during bull runs. They have what's called Altseason, where capital starts pouring into some of these lower quality projects. And then usually in the bear markets, it goes back to Bitcoin. But my question was long term, what's kind of preventing that from diluting the industry? And when I did more research on it, I basically determined that Bitcoin probably has reached a critical mass of network effects. And if that's the case, they can accumulate a lot of long-term value, while these other protocols, don't really play much heed to it. And so, from my perspective, there are only two protocols that have kind of a meaningful network effect, and those would be Bitcoin and Ethereum, and those are quite different. And so we don't really see necessarily a lot of competition there, although they do have some overlapping areas.
When you saw Bitcoin as something that had large network effects, for the benefit of people watching this, at what year did you actually start getting in, and was its price at that time relevant to you investing? The reason why I'm asking this is people right now are saying that Bitcoin is at 40 plus thousand. It may not be too early for me anymore. I'll just wait for it to go lower. What was your frame of mind at that point when you started?
Yeah, it's a really good question. So when I analyzed Bitcoin, I heard about it. I looked into it many, many years ago. But the first time that I wrote about it publicly and really took a look at it was 2017. And it was during that large bull run. And from that point, I looked at it when it was about, say, $7,000. And it was actually going up so quickly that when I started writing the article, it was like $6,500. And by the time I finished the article, like a week later, it was like 8,000. So we'll call it $7,000. And so I was analyzing it, and it had already had a very big run up. And there were a bunch of other questions, like it was splitting Bitcoin Cash and Bitcoin. We were seeing very strong price action out of Ethereum. Basically, we're seeing lots of different, distributed, protocols kind of competing. And so I was concerned about a couple of things. One was the big price run up. It looked too euphoric and expensive to me. And two, like I said before, I was worried about the network effects. So what makes one protocol kind of more durable than another? So I kind of passed on it. And of course, we had a blow off top, it went all the way up to 20,000. And then it fell, and it eventually crashed as low as, like 3,500 in the long run. So it was actually, it kind of consolidated in price for over 2 years, for like 2.5 years from that point. So it was actually a reasonable kind of decision to pass on it then. But during that time, I kept watching. And so we saw, for example, that the market sorted out between Bitcoin and Bitcoin Cash. The market basically answered that question of what's more important, the smaller block size or the larger transaction throughput. And the market preferred that smaller block size of the original Bitcoin. We also saw, institutional grade custodian solutions come out, right? So we saw more companies built around this space. And so when I saw Bitcoin have price weakness in the very beginning of 2020, during the COVID crash, so March, around that time, I actually bought into Bitcoin in April of 2020, ironically at around 7,000. So the same price that I analyzed it 2.5 years later, but I considered it de-risked because at that point I had a long consolidation. It answered some of my questions. And so I got in there. And it's funny because, most people, when they talk about their first time buying Bitcoin, they always feel like they're too late. They always feel like it's, most of the price actions behind them. And that can be true in the near term. I mean, Bitcoin's had these bubbles, in say 2014, 2017, and they can sometimes take years to recover. But so I would say for anyone buying Bitcoin with a 5-year view, and just if you kind of commit to holding it for 5 years or more as whatever percentage of your capital you feel comfortable with, something like that, I still consider there to be a lot of upside for Bitcoin. Like we discussed before, Bitcoin right now is something like 10% the size of gold as a market capitalization, less than that, probably like 8%. And so, even if Bitcoin becomes half the size of gold's market cap, that could be a 5 or 6 fold increase from here over a multi-year period. And so I actually still have a very long-term favorable view on Bitcoin. I mean, some estimates showed that, somewhere over 100 million people in the world probably own Bitcoin. And so out of 7 or 8 billion people, that's actually still a very small percentage. We're talking somewhere around 2% of the population owns some Bitcoin. And even if you narrow it down to smartphone owners, so that's about 4 billion, 4.5 billion people, somewhere around there, Bitcoin still is pretty early on in its adoption stage. And so when someone has a long-term view, I still think that these have long-term upside, as long as you're not too concerned about near-term price action, because they are volatile.
Speaking of near-term price action and then the long-term view, do you consider yourself as a part of the school of thought that I'm just gonna huddle onto this, or at a certain point, given that people take the halving cycles as references on the movement of Bitcoin, do you also consider selling at a certain point and then coming back in again when it's close to the next halving cycle, or I'll just huddle all the way, considering that it's still far from where it could possibly be and how valuable it is, comparing it as what you mentioned to the market cap of gold as well?
Basically, if it goes up at such a fast rate and reaches a surprisingly high price faster than I think, I could potentially sell into that if it becomes very euphoric. With the ideal that it's, for risk management, I might be able to buy more coins with the same amount of money later. And so I'm not, trying to time the market exactly, but if I do see a lot of euphoria, I would consider it. And so, for example, earlier this spring, when we started to see pretty much every coin was going vertical, right? So Dogecoin was going vertical, Ethereum Classic was going vertical. I warn my subscribers, this is no longer a particularly healthy looking market. And so I didn't sell, but I was making sure they were aware of the risks. And so we eventually got that correction. Now, if you were to see an even bigger, euphoric move, say next year, I would consider potentially trimming a little bit off the top. And that's more about risk management, making sure your allocation doesn't become too large of your portfolio, rather than trying to time the market precisely.
And when you say sell, you're parking it in stable coins or bringing it back to fiat?
I would potentially bring that back to fiat, but it depends on what the stable coin environment's like at that time. And so, for example, if you can get reasonable yields on your stable coin without taking too much risk, I think that's a reasonable type of diversification. In different parts of the world, we're seeing some more regulation pressure on some of these stable coins.